Hi, and welcome to episode 4 of Orrick Live. In this episode, we're going to do things a little bit differently. We're going to break this one down into two parts because we are going to talk about venture financings. And we know that's a near and dear to a lot of startup founders' hearts, and we really want to get into it. There's a lot of substantive stuff to cover. So in order to be able to cover everything, we're going to just break it into two parts. This part one, we're going to talk about what I consider to be the upstream part of the venture capital raising process. That means everything before you get a term sheet. So we will talk to one of my partners, John Bautista, who is based out of our San Francisco office and has done probably more of these financings than anyone could count. And also, we have the head of our global sales, Neel Lilani, with us today for this part of the episode. And Neel works a lot with venture investors and with founders raising funds from venture investors. So he will have some really interesting insights to add as well to the conversation. John, Neel, welcome. Thanks for joining us.
Thanks, Aria. Glad to be here.
Thanks, Aria.
All right, why don't we get started? And I'm going to start with a basic question for you, John, and then Neel. And that is, when should companies even think about raising a venture round? When should they actually take steps to do it?
Well, most companies are always in fundraising mode. They're looking for capital because they're pursuing businesses that are fast growth businesses and they need capital to fund their businesses. At the very early stages, it's usually when a founder or a couple of founders, once they've gotten together, decides they need to hire employees or contractors to help build the product or to test the product that they've developed with their own sweat equity and test that with customers. So it's very early in the process of a company's life that a company is looking for capital. And of course, once you hire people, you need to pay them. Minimum wage laws apply and these sorts of things. And the question about when you go to venture capital versus seed capital is an interesting question because we've seen over time companies delay when they go to venture capital because they can raise seed capital from angels and family and friends a lot more easily through safes and what we call seed financing rounds. And just a rule of thumb for founders in our experience is not to sell more than 15% of the company to seed investors. So when you look at the math, most companies will raise a couple of $1 million in seed capital, again, safes, convertible notes, other forms of equity from family, friends, and angel investors. And once they've exhausted that, then they're usually looking for venture capital. And VCs are going to, by and large, want a bigger stake in the company. They will want 20% or even more percent of the company. It's usually a bad idea to raise too much capital because at the early stage of a company's life, its valuation is lower, and therefore it'll result in more dilution of ownership to the founding team. But by sticking to the basic principles of trying not to sell more than 15% of the company in the seed round, anticipating that you will sell 20 to 25% of the company in the venture round, and adding to that a 10 to 15% employee pool, the overall objective is to ensure that the founders retain ownership of at least 50% of the company on a fully diluted basis post Series A financing.
Yeah, I think John's points make a lot of sense. The one other topic I'd like to bring into play here is that, when should companies raise VC funds was a question, but when should companies not be raising VC funds? They should not be waiting until they have 3 to 6 months of runway left, and then they're in a challenged and panic situation, and then they lose a lot of leverage during negotiations, and frankly are focusing on the wrong things for the business. Especially if you're in a challenging economic climate, which, as we know, happens from time to time as economies are cyclical. Waiting until you have very little runway left generally is a recipe for not succeeding. So I like to think that if companies are always fundraising, to be doing so with a growth plan in mind, so there's enough comfort, right? There's enough runway, ideally of 12 months, sometimes longer, depending upon how capital intensive the business is, their growth projections, et cetera. But those are some ideas around, when companies should not be waiting until to raise capital. Other thoughts on when should companies be raising venture capital money is, what's the history of the founders? Have they done this before? Do they have a track record of success? Do they have deep relationships? What do their growth plans look like? What is the anticipated use of funds? So that might the answers to those questions might encourage founders to be moving past seed capital earlier than some of their contemporaries who may not have a track record and may be their first go around, right? So I think these are all considerations. It's not a sort of defined timeline for any given company. I think it varies quite a bit, with taking into consideration history of the founding team, growth plans, and the type of business that they're growing. Is it a hardware business? Is it a mobility business, which is incredibly capital intensive in some cases? And accordingly, would they need to move past seed capital even sooner to help their business get off the ground?
And I'd like to elaborate on one of Neel's points, which is the 12 months. That seems to be a rule of thumb, is to raise capital that will last at least 12 months. Many times it's longer than that. And what the founders should look at is what the next milestone is in the business to get them to the next level of valuation. So they'll want to make sure they've raised enough capital to get to that next product development milestone, or customer acquisition milestone, or other metrics around the business. So when they go to the venture community, they can talk about the success that they've had, rather than running out of capital midstream on the way to the milestone.
Yeah, that absolutely makes sense. So it sounds like it's not one of those things where you wake up in the morning and you say, hey, I'm now going to go raise venture financing. It's one of those things you should always be thinking about, always working on. And I think John and Neel would agree, it's a good idea probably to have ongoing conversations with investors, both just so also what the supply of capital is at any time. Like Neel said, that can even change. So how should companies meet VCs? I know for the repeat founders it's probably easier, but for newer founders, what have you found works best?
Yeah, I'll start on that one. So I think that founders should be thinking about their networks broadly, and what I mean by that is thinking about professional networks that they may be part of. If they have alumni networks that have strong backgrounds in the technology ecosystem, prior employer networks. Did they work for a meaningful tech company in their past lives that would allow them to connect with executives there who have gone on to do other things, including to become investors themselves? I think so deeply thinking about your network, including some of the service providers that you happen to be working with, whether it be consultants or accounting firms, or in the case of law firms such as Orrick, we have a pretty well thought through process and program where we can help our promising founders think about the right way to access capital and the right ways to to talk about their businesses to those sources of capital. So, I think network broadly, absolutely. And in the instance where it makes sense, accelerators are a really strong option for some companies. And John can speak to some great accelerators that we've worked with over time. But I think that's also a great area to explore.
And one of those accelerators that we work with a lot is Y Combinator, very well known, one of the most successful investors in the world. And they've got a proven track record of helping founders build their companies. And YC's investment in companies has increased over time. I like to tell founders that just as investors are doing due diligence on the company, the founder should also be doing due diligence on investors, choosing an investor, and in particular, your first venture investor, is a very important decision for the founders and the company. The lead venture investor will be your partner for life in the company, because they will be one of the largest stockholders, in fact, the largest investor in the company, starting at the very beginning. They will serve on the board of the company. You will be tightly connected to that venture fund and to the partner at the venture fund who is your sponsor. It's important not only to look at the fund in particular that you might seek capital from, but who the individual partner and sponsor is within that fund, because raising capital and building companies, as you know, is a personal business. It's a business that's based on people, and having the right partner at that fund that will be collaborative, that will work alongside you and help you build your business is an important criteria, not just the capital that they bring to the table. And we like to look at funds for early stage companies that provide not only that personal touch, but they have the industry expertise. They're going to work with the founders over time. They will be able to offer the resources of the venture fund across the board in terms of helping founders build their teams, providing research on the market, and helping founders with customer introductions, and essentially becoming a co-founder in the business. So again, these are important due diligence aspects for the founder to look at when they're looking at which venture funds to talk to.
Yeah, and just one final point on that is, when you're thinking about what venture funds to talk to, don't think exclusively about venture funds that are on Sand Hill Road necessarily. There are some great venture funds that work with early stage companies in different pockets in different geographies around the country, around the world for that matter, as well as there are sometimes commercial relationships that you may have with a larger company that happens to have its own investment arm that may be interested in participating in an investment round, maybe not leading, certainly at an early stage, but perhaps participating. So keeping that in mind as you think about what is the population of investors that you might want to be speaking to is critical as well.
And those are excellent points. That you organize them via verticals, as Neel said. So Sand Hill Road type investors, industry specific investors, perhaps corporate ventures, and then within each one of those categories, have your top picks, but also have your second picks. And many times, we'll talk about this further in the conversation today, is many times you'll want to talk first to the second picks to be able to calibrate, to get a litmus test, to understand what their response would be before going to your first picks.
Yeah, that's a really interesting point, or I mean, a bunch of really interesting points that you both raised. But on the last point, it's being ready for your meeting with these VCs. So you've worked hard, you've identified the right venture capital partner to talk to in the right industry, in the right sector. Now you want to have a meeting. How should companies get ready for those meetings, especially those first meetings that are about making an impression and really starting the relationship right?
I think a couple things, right, to start off is you want to do your research, as John suggested earlier on. Understand what is going to motivate any given VC and understand what their portfolio looks like. Is your business going to be complementary to something already in their portfolio? Is your business potentially competitive to something already in their portfolio? So doing your research, understanding who the fund is, what the portfolio looks like, understanding the partner that you may be having an opportunity to meet with at that fund, what are their motivations, what are their backgrounds, understanding that well, I think is critical. Other things that you want to make sure that you're doing as a founder is having a clear and concise pitch. Coming into a pitch meeting with a 40-page deck or sending a 40-page deck generally does not go well. I think being really clear and crisp and being able to explain the business opportunity in, sometimes you may only have 30 to 45 minutes to do so in a 12 or 15 slide deck is pretty important, right? So refining your message after research, I think is pretty critical, and make sure that you rehearse your pitch. Understand what kind of questions might come to you. And while your core deck is going to be pretty tight, as we just suggested, have appendix slides available to you if somebody wants to dig in on your financial model. How do you plan to generate revenue? What does your margin look like over time? Be prepared to answer that in a meaningful way, but don't have that sitting as part of the sort of core part of the deck. And then understand what you might want to do as far as follow-up. Be thinking about that during the meeting. Listen during the pitch meeting. What kind of questions are you being asked? And make sure that you're prepared to follow up accordingly.
Also important is understanding their process within that venture fund. You'll most likely have one or two individuals within the fund, your sponsors. They mean, in most cases, they're not the decision makers. So understanding, how the decisions are made within the venture fund and what the timeline is. Some funds are, can move very quickly. Others have a longer cycle in terms of making an investment decision. Almost all funds have an investment committee where you will be invited in along with your sponsor to pitch the committee and to pitch the partnership at large. So there's multiple steps to securing a term sheet from a venture fund. Some venture funds as well, depending on your industry, will have outside experts need to do due diligence on you, people that they've retained to help. So the due diligence process as well is important to understand. In terms of readiness of your business, I totally agree with Neel that walking in with a 40-page slide deck is not going to be helpful. Ultimately, they will want to see that, but you'll have a limited amount of time to present. If you get to the presentation, the key as well is getting the initial meeting with the venture fund. And our team can be very helpful here in doing that. We usually ask founders to put together in 8 to 10 bullet points what the key features of the business is and the team, in order to do something as simple as sending an email introduction to the VCs that we know. And even attaching a executive summary is useful, but many times investors won't even open up an attachment, or they're looking at the introduction on their iPhone and they don't want to open up the attachment. So having something in writing, in bullet points that they can quickly glance at to determine if they're interested in having a call or a meeting is important. And those bullet points should include things like what's the total size of the market that the company is addressing? How far along is the technology development? What is the competitive advantage of the company and its team? And what is the background of the people on the team? So those are, and we can help provide, additional info on this, but getting those, 8 to 10 key bullet points is really important to getting the attention of the investors that you're going to be introduced to.
That's right. And, I think a lot of founders are excited about the company, the technology they're building. So there's a tendency to put all that stuff in there, but there will be more meetings. The point of the first meeting or two meetings is to get them interested in the business, get the VCs interested in the business, and then there will be plenty of time. And I'm sure the VCs are going to want to know, talk about the technology and all this exciting things in the company. So I think it's really important to keep that first one concise. Sounds like you both are really driving that point home here. So switching gears a little bit here, is it typical, I think we've kind of alluded to this, talked about it a little bit early in the conversation, but is it typical to talk to more than one VC at a time? It's kind of, I assume, a bit of a balancing act between time spent talking to VCs and putting all your eggs in one basket.
Right. Yes. No, that's a good question. And, there are some counterbalancing factors here. While you don't want to talk to every VC at the same time and spend all of your gunpowder all at one time, you certainly want to have a number of VCs that you're talking to at the same time. And one of the reasons is if you were to get a term sheet, or when you get a term sheet, you want to make sure that you've got other VCs lined up a parallel path, because once you receive a term sheet from a VC, you're going to be required to respond very quickly to whether you're interested in moving forward with that VC. And if you don't have other term sheets happening at the same time, you won't know kind of where you stand in terms of your overall investment strategy. If you have 2 or 3 term sheets at the same time, then it significantly increases your leverage in terms of negotiating the economic terms and the legal terms of the term sheet. You won't disclose to any of the VCs who else you are talking to, but you will likely tell them that you're looking at term sheets and you have term sheets from other investors. And again, that'll help you in terms of securing better terms and moving the process along more quickly. But we recommend talking to multiple VCs at the same time. As we discussed earlier, you might start with second tiers just to test the waters, and then move to first tier investors once you've got some feedback from second tier investors. And even if you've talked to some VCs and it is not a good fit, or you might be too early for them, you want to keep the conversation alive and send updates to them over time as you're making progress in the company's business. And then that will start to build some confidence with them that you can do what you say you do. And we've had many times where founders talk to VCs, it's too early. They take some funding from someone else, but they continue to keep that first VC updated as to the progress in the company's business and the particular sponsor at that VC. And they've got a great relationship over time, and that builds confidence to lead to a term sheet from that venture fund down the road.
Yeah, I completely agree with what John suggested around talking to multiple investors simultaneously. It's a matter of leverage, frankly. If you've got a single term sheet in hand and you've only got line of sight on this one investor, your ability to put together terms that might be more favorable to you are going to be far more limited. It's a matter of optionality. So making sure that you're early and often speaking to multiple investors. And I really like what John mentioned around, even if you're too early for the stage at which the investor that you're thinking about might be making investments, building a rapport with them sooner. If you're looking at a Series B plus investor, doing that when you're raising a Series A, getting on that radar. So when it comes time to raise that Series B, you're going to be well prepared with, at the very least, a group of potentially interested investors that you can go out to. Again, thinking about what John was mentioning around tier 2 versus tier 1, think broadly around what kinds of investors you may want to approach, and go to that network that we talked about earlier to get access to some of those additional investors that may not be on your radar. Get feedback. Talk to other founders even who have raised capital in similar types of companies, and understand what investors or groups of investors did they consider. So other things to think about as you're speaking to multiple investors.
Yeah, all very great points. John, you mentioned something that I want to pick up on here. You said once you get a term sheet, you have to respond very quickly. And from my own experience, the process from there goes very quickly usually. So question for both you, John and Neel, is what should the company do in advance as they approach that term sheet stage? Usually you have a kind of good sense that we're finishing the process with these VCs to get a term sheet. What should the company do to make sure their term sheet ready, if you will? What should they have in place?
Just a couple of thoughts here were they should be organized, have their data room or at least all of their critical documents and information in an organized fashion, so that when somebody needs to review those documents from an investor perspective, that they can do so efficiently and accurately. I think other things that companies should be doing are preparing really sound and defensible business plans that take into consideration what the current economic climate at the time might be, take into consideration your competition. And on that note, one of the worst things a company can do is say, I have no competition. I am in a world of my own. And generally, that does not resonate with investors. Everybody has competition, right? It may be a little bit further out than direct competition, but there's always competition. So be honest and be thoughtful about how you're thinking about the market and where you want to place yourself in the market. I think we talked about what a pitch deck should look like earlier, so I don't want to rehash that, but being able to support anything that you've talked about in your pitch deck with detailed plans, I think is also critical.
And we have a tool at Orrick. It's our Series A Ready tool, which is available for free on our website. And it is a diagnostic test that founders can go through, check the box, and creates a report for them as to what areas they need to focus on to be ready for Series A funding. So it's a quick and easy test to take. And I think it's very informative and is sort of an A to Z checklist of all the different factors that go into being Series A ready. The term sheet is a non-binding document. It will set forth the summary of the terms, the valuation, the size of round, size of employee pool, what the preferred stock rights are that the investor and company agree upon, what the board composition will look like, what founder vesting will look like, et cetera. There will be in most term sheets a provision that's called a no shop or exclusivity provision, and that part is binding, which means that once the company has signed the term sheet with the VC, all bets are off in terms of conversations with other VCs. So, and that usually lasts 30, sometimes 45 days. If there are other investors that can get tucked into the financing round, if it's contemplated that there's room for additional capital, those conversations are fine. But talking to other investors after you've signed a term sheet is where there's exclusivity provision, cannot and should not be done, because you'll be in violation of that exclusivity provision. And then the process from there is getting the documentation completed, the due diligence completed. It's really when the lawyers roll up their sleeves and get to work and help complete the financing round. However, once that term sheet is signed, there are a lot of things that should have happened prior to the term sheet signing that founders need to be aware of. In addition to doing the diagnostic, if the company is planning to grant stock options to any employees or to issue shares, it's very important to have those stock allocations done before the term sheet is even received. Once a term sheet is received, there's a valuation discussion and a meeting of the minds on valuation. And so there's a window prior to receiving a term sheet when founders can grant to their employees stock options or stock grants at lower prices per share than once the term sheet is received. So it's important to have a conversation with your lawyer about that to make sure you've got the 409A or other valuations in place to do any stock allocations before the term sheet is received. The other thing is to focus on board composition. There may be some changes at the board level. You may want to add an independent director or an industry expert to your board, and thinking about that ahead of time, what the board composition is that you want to have going into the venture round is important to focus on prior to receiving the term sheet. The third thing is founder stock ownership itself. Founders may want to have their shares or a portion of the shares in the form of founders preferred stock, which is something we created at Orrick. So prior to receiving the term sheet, if you want to implement founders preferred stock for a portion of your ownership, it's best to do so at that point. And the fourth thing is company IP. You want to make sure that all the steps that were needed to ensure that the company owns all of its intellectual property are taken care of. So for example, that founders have signed all the confidentiality and invention assignment agreements, that anyone who provided services to the company in the form of consultants or contractors, that those agreements have been secured. And also anyone who's provided employment services to the company, that those contracts are secured. Sometimes when people learn that the company has received a term sheet and they have not assigned their IP to the company, they can use that as leverage to get more cash or more shares out of the company because they will perceive that the company is more valuable and that their IP is needed, to complete the venture financing round. So it's good to get all of those arrangements around equity and around IP ownership taken care of before the term sheet is received.
Thank you. Those are really great points from both of you. And for those of our viewers who want to hear more about kind of what you need to do to get the company organized, which you should do before you raise any outside money, John and I actually did talk about that in length in, I believe, our episode 1. So if you all look on the website, there is a good discussion about that as well. And John, you kind of raised one of the points that I hear clients always wonder, which is when should they involve their outside counsel in this process? You mentioned some of the things. Certainly at the term sheet stage, the outside counsel can be a valuable strategic advisor and kind of let you know as to the legal terms. When do you recommend that you get involved or Orrick gets involved?
As early as possible to help with the corporate work that we just mentioned, board composition, founders, preferred stock, employee equity, IP ownership, to get these sort of checklist items taken care of, as well as helping to coach the founder in the venture term sheet negotiation. When founders negotiate the terms with VCs, they will be the ones who are on the front line negotiating. It's usually not a good sign if the founder punts the term sheet negotiation, especially the critical terms like valuation and size around and what type of preferred stock and board composition and founder vesting. If the founder were to punt these items to the founder's lawyer, that's not a good sign. And in fact, from the VC's perspective, the first test that a VC will have of the founder's ability to negotiate will be negotiating with the founder in the term sheet itself of the venture round. And of course, founders need to be good negotiators because they'll be negotiating with customers, they'll be negotiating with corporate partners, they will be negotiating with executives that they hire. And VCs want to know that the founders of the company, in particular the CEO that they're investing in, is a good negotiator. That doesn't mean the founder will do it all. And in fact, a reason to get us involved early is we will provide the coaching to that founder. I've had many times founders just before walking into a negotiation with the VC call me up and literally coach that founder for 20 or 30 minutes before they walk into the room, or once they've left the room, to try to understand what were the important points that were discussed and how to respond back to the VC. So we provide that coaching tool, that coaching benefit to founders, and being prepared in advance and being up to speed as to what the VCs will ask for and understanding venture terms. Will spend a lot of time with founders, getting them up to speed and coaching them along the way. Other things from a preparation perspective that are important is modeling out what your cap table will look like post financing. So understanding the impact of dilution as a result of valuation, as a result of the size of round, and understanding what the impact of dilution is when your safes, if you have them, or your convertible notes convert. based on the venture terms. So you can walk into the negotiation knowing what is the limit in terms of the size of the round you want to take, and what's the limit in terms of valuation. So what we will do is help founders prepare a pro forma cap table, a spreadsheet that they can actively use to model the different types of venture rounds that they're discussing. And last is the term sheet itself. Many times we deploy a strategy where rather than waiting for the VC to present their term sheet to the company, and in particular, if companies are expecting to receive term sheets from multiple investors, that we will proactively prepare a term sheet that will go out to all the interested investors, and the blanks to be filled in by those investors are valuation, size of round, and other economic terms. But at least we have all the investors on the same page as to the rest of the terms, and that makes it easier for the founders to compare and contrast the term sheets as they come in.
Yeah, and I think picking up on something that John mentioned, talking to Orrick earlier on would allow you as a founder to understand what our experience has been with many other companies of similar structure, scale, size, industry, and take those data points into consideration as you prepare. In fact, we have a dedicated group here at Orrick that helps our founders prepare for fundraising by helping them refine their strategy, understand what other investments have been made in the ecosystem in recent history, let's call it, and understand what to expect in large part when they're walking in the door with any given investor. So while you may think of your law firm historically as somebody who's doing just your formation and deal work, we're really a strategic partner with our founders, and we encourage them to bring us into the equation as it makes sense for them.
That's right. And Neel, your team helps with, even as you mentioned, identifying the correct investors to approach. So very early in the process is when your team gets involved. And of course, John, I know that you have an ongoing relationship with most founders, so you always can advise them on how to proceed with these conversations they're having, even before they get to the term sheet stage. So that's all great. And speaking of conversations, I know that in a lot of these meetings, some confidential information gets disclosed. Venture capitalists are investors in nature, so they're wondering about financials, things that the company might want to hold kind of close to their chest. And historically, I think that the sentiment has been that maybe VCs don't sign NDAs, so it's kind of a trust relationship. What's your experience, I guess, recently? Has that changed? Do VCs sign NDAs? What should founders do if not, to protect kind of the sensitive information that they need to share with VCs to get these term sheets in the door?
As a rule, VCs don't sign NDAs. We do see some, for example, on the corporate VC vertical, but as a general rule, Sand Hill Road type VCs don't sign NDAs, and this is because they're looking at all kinds of business plans, and there very likely is already a portfolio company of theirs that is in a similar industry. And what founders need to do to protect themselves is to make sure that their key contact at the venture fund is not someone who's on the board or already invested in a competitor. If the fund is invested in a competitor, that is the company's number one competitor, avoid that fund. That's probably not going to be a good fit. So this goes to our point earlier around doing due diligence on the fund and understanding who the other portfolio companies are that the fund has invested in, and the background of the VC individual that you'll be talking to. The second thing is, you don't have to disclose everything in your first couple of meetings. You can gauge the level of interest that the VC fund has, and as the conversation continues, then you can reveal more as there's more of a trusting relationship between the company and the VC. The third thing is, nevertheless, we recommend marking everything as confidential. Your business plan should be marked as confidential. Your executive summary should be marked as confidential. And when you send it to the VC, it'll show up as confidential. That creates a burden on their part to maintain the confidentiality. It may or may not be legally enforceable, but nevertheless, it does communicate to them the importance of keeping that information confidential and to the limited set of people that it's been disclosed to.
Yeah, I think another way to think about this is you don't want to put your most critical confidential information in the first deck that you're sending to an investor, right? I mean, the idea is to tease out their interest, not to give them, to provide deep detail on your financial model, et cetera. That comes later. So being able to distill down what you're trying to convey to an investor without disclosing anything that you would perceive as problematically confidential. I think that's critical as you're preparing to speak to investors. If you go to a group of VCs that you're targeting and individually say, unless you execute this NDA, we're not going to share anything with you. I think unless you've gotten an amazing track record of success, you're a serial founder and you've had multiple exits, the likelihood that you're going to get any real meetings is pretty low, frankly. So I think John's points summarized it well, that as a general rule, do not go out looking for an NDA from VCs.
I had mentioned earlier that some VCs will have outside experts who will do a deep dive in due diligence. In those cases, where there's a real deep dive due diligence on technical aspects of the company's technology, when you get to that stage, having a conversation about an NDA is something you should consider. And in particular, if they're hiring a third party, then I think there's a good opportunity to have that third party sign the non-disclosure agreement, which could be a third party company or a third party individual. And that party will then render a report to the VCs, which is basically a thumbs up. Yes, everything we thought this company said they had under the hood is correct, but we can't disclose to the VC all the details because we've signed an NDA. So again, keep your lawyers updated as to how much detail the VC is asking you to disclose, and so that we can keep abreast of when it might be the right time to ask for a non-disclosure agreement.
That's right. And I think you both mentioned this point. It's a process. So as the process unfolds, there will be more and more discussion, opportunity to share more and more sensitive information. And worth noting that diligence doesn't all get done before the term sheet. A lot of it gets done after the term sheet, including the deep technical dive that you just mentioned, John. And one of the and we'll talk about this more in the second part of this episode, but one of the other binding provisions of a term sheet usually is the confidentiality provision, actually, which once the term sheet gets signed is in place, and then that provides more comfort as well. So that actually brings me to my segue here, which is to say, as I mentioned at the top of this episode, we're going to break this into two parts. The second part will be a more detailed discussion of some of the legal terms in the term sheet and in the financing documents for a financing round. So I hope that everyone tunes in. We'll continue this discussion and get more into those finer but very important points. So Neel, John, thanks a lot for your thoughts, for taking the time to be here with us today. I really enjoyed our conversation, and I look forward to continuing it. Thank you.
Sorry.
Thanks, Aria.